So first, let's start off and let's address the big elephant in the room. And we know that sort of for the last few years, returns have been sluggish. But prior to that, we had happy investors. Before 2014, even through the great financial crisis, investors were happy. Returns were positive, there was less political noise, and everyone was just positive sentiment. But the big question is, how do we position this, and how do we put those expectations in place from where we've come? And the first point of call is just to remind ourselves where we've come from. Right, so we've come from a period, had you been invested since 2004 up to 2014, you would have grown your money roughly 400%. I mean, hence the happy investors before 2014. If we just roll that forward a little bit, and we look since 2014 onward to 2017 on this side, 3 years, you would have grown your money a whopping 7.4%. That's roughly 2.4% per annum. Hence the unhappy investor. So we understand this, and everyone's going through the same emotions. Client return experience has also been different. So it's all great to say, let's look at the all share, but not everyone's investing in the all share. So your return expectation or return experience is not a good replicate by the all share. So let's look at client experiences. So the green chart, if you can see it over there, is equity general, right? These are general equity funds. So over 7 years, you would have got roughly 10.7% per year. As we move down the curve, we see in the orange space here, we can look at the balanced funds. And it's always funny when I go see clients with advisors and the risk profile question comes up, everyone always wants to be balanced, moderate, not too aggressive, not too conservative. As we move down the risk scale, we can see that obviously returns taper off, but that's as we invest into more cash-like instruments. The most important thing I want you to notice is this inflation number here. The last one, 5.5% is the average inflation over 7 years. Let's roll this on in 3 years, right? In the last 3 years, had you invested in equity, 2.9% would have been your return. So significantly down, from 10 all the way down to 2.9%. The balanced fund, where everyone sort of invests in, 5.5%, and inflation at 5.4%. So what we can see is that your balanced fund, where 90% of people invest in, is equaling inflation. Now this is obviously a concern. This means that slowly but surely, you're technically getting poorer because you're not beating inflation. As bread gets more expensive, as milk gets more expensive, your money isn't growing fast enough to keep up with that. Hence the unhappiness, right? So we understand that. If we roll over to 1 year, it becomes a serious problem, where equity returns are only at 2.3%, 4% for your balanced fund, and significantly below the 5.5% for inflation. So there is concern, and there's reason for this unhappiness within the market. You're also asking yourself, why bother with growth assets in any event? It's like, why invest in the market if this is the return experience that we're going through? And here's a great picture to just remind us as to why we stay invested in the market. This is South African all-share exchange over 40 years. Now, 40 years is a proper investment cycle. It's a proper investment period. 3 years is but a blink in that. So this is a couple 1,000% return. At the bottom here, you can see cash and bonds. So that's sort of money in the bank versus the equity market. And then I said to myself, all right, well, if this is a South African all-share exchange, maybe I'm being naive. Maybe this is the African growth story, right? Maybe it's not like this all over the world. So I like to test a lot of scenarios to make sure my sort of discussions with clients. So then I looked at global equities. So this is global equities in hard currency, in dollars. And this is the red chart. Slightly more staggered, but still a massive outperformance versus bonds and cash. So we know that over time, equity will outperform.